Ladies and gentlemen, welcome to the second episode of your hometown friend, the Bank of St. Elizabeth podcast. Today, we're talking with Steve Massman, Bank of St. Elizabeth. Steve, welcome to the podcast.
Good morning. Thanks, Dave.
Today, we are going to talk about secondary market loans. And I think to start off, maybe we should just come out of the gate with what is a secondary market loan.
Well, this is going to be some really exciting information, Dave. Sitting on the edge of your seat already, I can tell. The secondary market loans are maybe more what folks are familiar with. It's maybe more of what you see on the internet or read in the newspaper or magazines, etc. It's 30-year fixed rates, 15, 20-year fixed rate home loans. In the background, and this is kind of transparent to the borrower, but those things get sold to Fannie Mae, so you might see some reference to that. And Fannie Mae is just a kind of a government-sponsored agency created a few decades ago to promote homeownership. So that part, like I said, is transparent to the borrower, but that's ultimately what those things are. They're sold to Fannie Mae. But again, the biggest thing that you get with that is the fixed rates, 15, 20, and 30-year fixed rates that you don't see on typical in-house loans.
Okay. And so there's three secondary market loans. Typically, there's a conventional, there's USDA, and there's FHA.
Yeah, that's right. And then you can do some VA stuff too.
Okay.
VA is the fourth animal of those, and they're really not that much different than an FHA. The only difference would be they're only for members of our armed services.
Okay.
They're the only ones that qualify for those.
And so can we start off, can you kind of explain what a conventional secondary market loan?
Yeah. Conventional is it's kind of like the Beatles of the music world. You know, it's it's the most typical. It's anybody off the street, as long as credit and all those other things line up, can get into. There's no required home inspections. The home doesn't have to meet any certain qualifications or anything like that. It's purely based on the borrower. So the borrower's got to come on with a minimum of 620 credit score. They've got to have a minimum of 3% down if they're a first-time home buyer, or 5% if they're not a first-time home buyer. But again, it's that typical loan. It's the one that's most typical. I would say 85 to 90% of the loans that are done on the secondary market are conventional loans, because again, there's no qualification outside of you, the borrower's qualification on those. You can get 30, 15, 10-year fixed rates, 20-year fixed rates on those things. Again, just the most typical of those three.
Okay, so that's kind of the garden variety secondary market loan. The second one we should talk about is a USDA loan. Now, is this for homes that are not within a city, almost like kind of like a rural area?
Yeah, that's exactly right. You have to be out in a rural area, or the home has to be out in a rural area to qualify for these things. They come with a United States Department of Agriculture guarantee. That's where the USDA comes in at, and they guarantee part of those loans. So what that allows you, the borrower, to do is to borrow 100% of the purchase price. You can come into that with no money down. Typically, sometimes you'll even have a seller that will cover closing costs for you, so you can actually buy a home with nothing out of pocket whatsoever. They'll cover closing costs for you, the seller of the home will, and you can come into it with a no down payment because, again, there's that guarantee there. Again, a couple of the different things there. You can still get the fixed rates on them, 30 years and 15-year fixed rates on those things. But the biggest thing is the home has to meet certain qualifications. As you said, it's got to be out in a rural area. And there's maps online for those types of things, but we're here at the bank can look that up in a matter of moments with an address and tell you if it's going to qualify or not. But the home has to meet certain qualifications as well. And there's nothing too stringent about them. You know, there can't be peeling paint. There can't be steps without banisters, those types of things. More what we call health and safety things. If the home is built on a crawl space, there has to be vapor barriers, those types of things. So nothing really extraordinary on those things, but just certain things that you'll look for that the home has to qualify for beyond you, the borrower. Back on that conventional one, it was just you, the borrower, that we had to worry about getting qualified. In the case of USDA, we've got to worry about the home a little bit too. But the biggest one, like you said, is out in a rural area.
Okay.
Those are a lot of times, and it doesn't have to be a first-time home buyer, but a lot of times first-time home buyers will look at USDA loans only because a lot of times those funds for down payment are limited. And so they can come into those, like we said, with nothing down. So it doesn't have to be a first-time home buyer, but typically a lot of first-time home buyers tend to go that way with a USDA loan.
Okay. And so let's talk about FHA.
So FHA is similar to USDA in that there's a government guarantee behind it. So what it allows you, the borrower, to do is to come in, again, with less of a down payment. So you can come in with 3.5% down. That's the minimum that you have to have down on an FHA loan. That can be a purchase or a refinance. So you want to go in and refinance your home loan, and you have minimal equity there because maybe the market has come down, or maybe you just purchased it, but rates have come down a little bit. You can jump into these FHA loans. Similar to the USDA in that the home has to qualify. Same things, the health and safety things that we talked about, peeling paint, banisters on steps, those types of things. Again, just health and safety. The difference between the two, FHA, USDA, or the biggest piece is there's no qualification on where the house is. You can be in the middle of a city, Jefferson City, Columbia, Ashland, wherever, all those spots are going to qualify because you don't have to have that rural aspect to it. A lot of times FHA is useful for a borrower who's maybe got some credit hiccups. They'll do some things that USDA won't and conventional mortgages won't credit score-wise. So if you've had some issues in the past and your credit score is down, even in that 580 to 620 range, those will still qualify for FHA loans.
So what? I don't know. Did we hit on what the credit score ranges for the USDA?
On USDA, there's two different ways you can go. You have to have, if you have a credit score generate, then you have to have a 640 or
640,
above.
okay.
If you have no credit score generate, so again, you're that 22-year-old kid who's never borrowed any money before anywhere. You don't have anything negative on your credit report. You just have nothing. We can do what are called manual underwrites. And so what we're going to do is we're going to gather 5 of your bills that you pay, your cell phone bill, your car insurance, your electric bill, your rent if you rent now. We're going to get 12 months worth of history on 5 different bills that are in your name.
You're essentially establishing a credit history.
Exactly right. Okay. Exactly right. We're manually underwriting and establishing that credit history for you. If you're a 0 score, a no score borrower, but otherwise, if you have a score generate, USDA has got to be the 640. Or like I said, that FHA will go down to a 580. So again, if you've got some challenges, there's some hiccups there in the past, we can still qualify you with FHA. And again, only the 3.5% down.
Okay. So, I guess, what are some of the myths? What are some of the misconceptions about secondary market loans? I know there's a lot of information out there. There's commercials, there's radio ads, there's everything else. What are some of the misconceptions that you see a lot of that people come in and have that you're excited to
dispel?
Yeah.
Yeah, I think there's a couple of them. One is on the down payment piece of things. You don't have to have 20% down. 20% down on a conventional mortgage allows you to avoid mortgage insurance, but you don't have to have 20% down. You can get into those things, like I said, with as little as 3 or 5% down on a conventional, 3.5% on an FHA, and again, nothing down on USDA. So you don't have to come in with, hey, I've got to have 20% down in order to buy a home. That's not the case. And I think that myth is out there, and people still believe that you got to have those things, and you don't have to have 20% down. Then on the refinance side of the house, a lot of people say, well, I've got to save 1% off of my rate. If I have a 4% rate now, it doesn't do me any good to refinance unless I can get 3%. And that's not really the case either. Depending on what you owe against the home or how long you think you're going to be in the home, you can get by and it makes sense. Save 0.5% or a little bit less even in some cases on your rate, and it makes a lot of sense to refinance. And those are things we can talk over and crunch numbers for you and discuss. Hey, here's kind of a time frame it's going to take you to recover some closing costs, et cetera, of that refinance. But again, those are myths out there that say, hey, I've got to save 1%. Well, if you owe a decent balance on the house and you say, hey, this is my forever home, I'm going to be here. Yeah, it's going to to make some sense, even if you can save 0.5% to go ahead and refinance.
And those rates are down.
Oh, absolutely.
It's a good time to
absolutely. Absolutely. We've got 30-year fixed rates, on the conventional side of the house in the upper threes, and on the FHA and the USDA, those things are in the mid to lower threes. So, yeah, absolutely. And then one of the other things that it allows you with rates down at this time is to lower your term, is to say, hey, I want to go from a 30 to a 15, and because rates are down a little bit, hey, I can do that, shave 5, 10, 15 years off of my mortgage and not see that much of a difference in my payment because, hey, I've lowered the rate down a little bit and I've paid it down a little bit since I originated the mortgage that I'm refinancing. So, yeah, that's one of the other big things that you can do in these low rate environments is, not only, like I said, save on the rate, but also save on the years. And that's really where the rubber's going to meet the road at with saving you money, is if you can pay it off 5, 10, 15 years quicker.
Fantastic. Steve, anything else? You have any closing thoughts for today? I think we've hit the secondary market loans. What else is going on in Steve Massman's world that needs to share?
Well, Dave, it's not a lot. I've got a couple of kids at home, and so it seems like all I do is chase them. But we get into the holiday season here, and people kind of go into hibernation almost, between Thanksgiving and Christmas, and I guess just remember that that's a good time to go out and buy a house, because the sellers out there are still wanting, obviously, to sell their place. And if there's a limited amount of more buyers out there looking for places, that really puts you in the catbird seat because that seller isn't going to have a whole bunch of other offers on you. So, while everybody else is in hibernation, that's when you need to be out house hunting. And, hey, give us a call here at the Bank of St. Elizabeth, and we'll see if we can get it financed for you.
Steve, can you quickly recap the Cardinals season this year? Was it everything you expected?
Well,
did they get as far as you hoped?
Yeah, hoped? No, obviously not. But I remember.
I didn't know if it would be one of these, like, at the beginning of the year, like, I just hope they make the playoffs, man.
It was like the Screaming Eagle, Dave. You had these highs in April where, they looked like they were maybe the best team in baseball, and they did that again, in the end of August after the All-Star break. But then they had these lulls in there where they just had terrible months. And so, yeah, the anticipation was building after they beat the Braves. You were at the top of the hill on the Screaming Eagle, and boy, they played the Nationals, and it didn't look good. This is the point in the Screaming Eagle where you bottom out at the bottom of the hill. So, they've got a lot of decisions to make here in the offseason. What are they going to do with the outfield? What are you going to do with Matt Carpenter? Where does Tommy Edman play? They've got a lot of decisions to make, and it'll be exciting. That's for sure.
Whose contracts are coming up this year? Do you know?
Wainwright's a free agent. I think it's retirement or come back to the Cardinals. I don't think he's going anywhere else, and I think that's totally his decision. If he wants to come back, I think the Cardinals would welcome him back. Ozuna is a free agent. That's also another interesting case.
He had some kind of ups and downs this year.
He did. He was kind of a microcosm of the season, really.
Yeah.
He came back from injury and took him a little while to get going. He got going, got hot, carried him for a couple of weeks, and then fell off again. So, yeah, he was kind of a microcosm of the season again. Had his moments, but he's an interesting test case. They can have him back on a 1-year deal if he's willing to play ball, and maybe that's the best thing for him. That gives Dylan Carlson another few months or a year to develop at Memphis, and you don't have to pay Marcel a lot, at least long term. So, it sounds crazy to say $18 million isn't a lot, but in the scheme of baseball payrolls, Major League Baseball payrolls, $18 million for 1 year is a fairly low-risk option. So you might see Ozuna come back on something like that. But those are the main two free agents that you'll see are Wainwright and Ozuna.
So, quick recap on the Cubs season. I'm just kidding.
Very enjoyable. Very enjoyable, especially the 4-game sweep in Wrigley. Very enjoyable Cubs season.
It's great. Well, thank you so much. That concludes today's episode of Your Hometown Friend, the Bank of St. Elizabeth podcast. Big thank you to Steve Massman, Bank of St. Elizabeth, for talking with us today on this chilly, rainy Thursday afternoon. Please stay tuned to the Bank of St. Elizabeth Facebook page, Instagram, and our website for future episodes. And ladies and gentlemen, that's a wrap.